Audio is on. Hey everybody, welcome. I'll pass it over to David to start to kick this off.
All right, here we go. So welcome to the webinar. We're going to be talking about climate opportunities and in the investment landscape in particular. Just by way of introduction, my name is David O'Leary. I wear a couple different hats professionally. One is I am founder of Kind Wealth, which is a financial planning business focused specifically on a younger demographic, kind of 30 to 45-year-olds. We offer only financial planning, and we help clients sort of align their values and their money. So that can look a lot of different ways, but one of the ways that people are increasingly interested is from the investment standpoint. The other hat I wear is as managing director of Origin Capital, which is the impact investing division of World Vision Canada. And essentially there, we're looking to create investment opportunities that allow Canadians to impact the lives of vulnerable people in some of the most vulnerable countries and hardest to reach places. So that's just a bit of my background. I'd love to spend a little more time now just introducing my guests. So to my immediate right is Sarah Keys, and Sarah is a principal at ESG Global Advisors. She has a decade of diverse experience as a thought leader, consultant, and auditor. Sarah is a recognized voice on the financial impacts of ESG issues for the Canadian business community. She's a speaker, author, facilitator on the impacts of climate change risks and opportunities, including on governance, strategy, risk management, and performance. And her previous role was at CPA Canada, where she developed research and guidance on climate change issues and implications for business decision-making, reporting, and oversight. Sarah received the 2018 Emerging Leader Award from CPA Ontario for her work, her innovative work in climate change and sustainability for the accounting profession. Next to Sarah is Hye-Won Kong, and Hye-Won manages the AGF Global Sustainable Growth Equity Strategy, investing in solutions to sustainability challenges to create positive impact while leading ESG integration and ESG committee at AGF. She's a member of the investment committee of the Municipality Endowment Fund, also known as the Atmospheric Fund, and she serves on the Environmental Finance Advisory Committee at the University of Toronto. Hye-Won is a CFA charter holder and a member of the Toronto CFA Society, and has co-founded and co-chairs the Toronto Responsible Investment Working Group. So welcome Hye-Won and Sarah. And just on our end there, last but not least, is Jennifer McDonald. As manager of impact investing at CoPower, Jennifer develops and implements client growth strategies and assists CoPower's existing green bond holders, providing support and building engagement. She joined CoPower after 4 years as an associate on the institutional investment management team at Phillips Hager & North, which is now part of RBC Global Asset Management, where she helped manage and monitor institutional client accounts ranging from pension plans to foundations and endowments across Canada, provided coverage for the firm's global and emerging market equity strategies, and helped develop and integrate ESG initiatives. So welcome. I'm very excited, number one, to be the only man on this panel, which is a very stark departure from the traditional investment industry, which is still heavily skewed towards men. I'm also excited because there's just like a wealth of experience and expertise, particularly in climate, on this panel, which is not my area of particular expertise. I've got broad familiarity with it, so I'm really excited to hear your thoughts and pick your brains. So with that, let's just dive right in. I'm going to pose this to everyone, and maybe we can just go in this order from right to left. But talk to us a little bit about how your organization is focused on climate, and then specifically your role within that, and what do you see as the opportunities for climate awareness and the risks of not integrating it? Maybe Sarah, we'll start with you.
Okay. Thanks for having me. It's fun to be a part of this esteemed panel, and I'm looking forward to hearing what you both have to say, because I always learn something new from both of you. So ESG Global Advisors, we're a relatively new advisory firm. We focus on bridging the gap on environmental, social, and governance issues between companies and their investors. So myself, I've been predominantly focused on working with companies in this space, helping to meet their evolving investor information requests and responding to their asks around ESG progress. So our focus is very much so on the capital markets, as is everyone else on the panel. So ESG being distinctly different from CSR in that it really focuses on those issues that are of financially material to long-term value creation, which of course is what investors care about. So climate change is considered one of the top ESG issues, of course, because it's so pervasive and systemic. So you can't diversify away from it. Some recent research out of the United States Sustainability Accounting Standards Board has indicated that 93% of US equities are materially exposed to climate risk. And that includes everything from policies to transition to a lower carbon economy, as well as impacts of physical risks that we're starting to see more and more of in the form of frequent and intense extreme weather events. So it's interesting because it's not only high emitting sectors. So you would think, only energy and mining companies need to worry about this. And while they are certainly the types of clients we're working with, we're also working with clients in some of those sectors you might not think are directly impacted by climate change. So things like food and beverage companies, which have extended supply chains in many cases and are starting to experience extreme weather, which is impacting operations as well as the ability to source key inputs to their processes. A couple of other examples being technology companies. Energy usage is a huge issue for them, and banks on the lending side, which I'm sure my colleagues can speak to even more thoughtfully than I can. But fundamentally, I think companies traditionally have shied away from talking about the issue of climate change because they didn't understand its relevance to the key things that keep the business going, like financial performance, and how does it link with strategy and risk management? Why should the board care? And I think increasingly investors are driving that agenda within the corporate world, especially in Canada, where companies are really starting to get asked and bombarded by these requests from their investors saying, ESG matters to us, climate matters to us, what are you doing about it? So the risk here is being caught out, if you're not aware of how climate change could impact your business, the risk to companies of not knowing is getting caught out in either a public forum, perhaps a vote against at an annual general meeting, which no company likes to experience, or even getting letters sent directly to your board and your CEO, which raises a lot of questions internally. So certainly lots of risks if one doesn't pay attention, but the flip side of risk is opportunity. So companies that are proactive, forward-looking, have an opportunity to capitalize in the transition to a low-carbon economy and meet some of those needs of their investors, but also the growing demand from consumers and the ability to attract and retain good young talent who increasingly cares about this stuff.
So lots and lots of reasons to care about it. Can I just ask a follow-up question before we move over to Hewan? You had mentioned in passing here, and we spoke actually just before off camera on this, but the sort of CSR, so corporate social responsibility, and the difference between sort of, I think you're getting at, is sort of doing a little bit for the environment on the side as this, with a little bit of money, we do an event to buy some good PR, versus incorporating ESG into fundamentally how you run your business and mitigate the risks. Can you just sort of expand upon that? Because I think that's really interesting.
Sure. I mean, fundamentally, I think our firm's whole thesis and reason for being is this growing area of ESG, which is really, in our minds, a subset of these traditional CSR issues, which are critically important to a whole variety of stakeholders, right? So CSR addresses employees, customers, communities, you name it. And CSR has been around for a long time. What's relatively new, growing, and emerging is the investor interest in how some of these most material CSR issues, also known as ESG, are impacting long-term value of the company. So it's really a subset of those CSR issues that could materially impact the value of the company, and it finds its way into strategy, risk management, and external disclosure and reporting to your investors. So really simply put, CSR is about values, ESG is about value.
That's great.
Yeah, and also just adding to that point about CSR versus ESG, and I think it's critical to understand what investors now asking on ESG issues typically are focusing on materiality assessment. So the company has to understand what are the material issues for their own operations, for their own stakeholders, and address those issues that are key and material to the company. opportunities, not necessarily just addressing every stakeholder and every community or talking more about the charities, but I think we have moved on.
Mm-hmm. That's really interesting. So, Hewa, can you talk to us a little bit about your organization's role at AGF and your particular role within AGF and how this is sort of relates to your work?
Sure. So AGF is an independent asset management company. We manage about over 30 billion assets under management, serving over 1 million investors. So we have different investment solutions that we provide to our investors, including retail investors and institutional investors. And my role within the company is so I manage this impact portfolio, particularly focusing on investing in climate solutions, investing in environmental and social solutions. So focusing on the companies that are actually benefiting from the transition. The world is transitioning to more and more sustainable economy, and we want to benefit. We want to find those opportunities. So the fund is focusing on basically the solution and opportunity side. And at the same time, also, I'm leading the ESG integration at AGF, so working closely with our investment team and also other teams across the company. The climate change has been a very interesting issue because climate change doesn't only affect the investment, but it has to be incorporated in a different operational side. So we also established ESG committee at AGF Investment and also Sustainability Council. So both structures, so within the senior leadership and within the investment team, we are trying to understand what are the climate risks or opportunities that AGF is exposed to, and trying to understand. So we almost think about ESG as a better awareness tools that help our investment decision making to help our investment return and protect our clients' return and also the social benefit. So at the same time, what we are trying to understand is how we can also benefit from climate risk and opportunities. That there's where the strategy like our fund works on these issues. And now we also have some kind of the sector analyst meetings. The next meeting that we are going to talk about will be thinking about the climate risk and scenario analysis and how we are going to address this.
Great, that's really interesting. And Jennifer?
Great, yeah, it's a good juxtaposition next to Haywan. So CoPower manages just over 20 million. That's million with an M. Yeah. We have over 700 investors across Canada. And CoPower's main specialty is financing or providing access to financing for the smaller, more decentralized clean energy projects across Canada. So our flagship product are our green bonds. So they are offered to retail investors across the country through our platform that want to invest directly in the clean energy transition. And so my background, as mentioned, I previously came from RBC and joining CoPower because we heard from a lot of investors that they wanted to access something that was different from the investments in their portfolio, but also that had a measurable impact. And so part of my role at CoPower is educating investors across the size spectrum, so retail to institutional. And about 1.5 years ago, we put out a paper that identified what is the carbon footprint of an individual versus their investment portfolio. And so for investors, we all have a carbon footprint of about 21 tons. And there's a metric, which is around 300,000 as we grow our investment portfolio, where our investment portfolio has a higher carbon footprint than that of the living and breathing individuals like all of us in this room. So for me, it's important to work with clients to understand, it's not enough, even if you're riding your bike into work, even if you're trying to use your dryer less, it's important to kind of look under the hood and look at your investment portfolio. And while public market equities are still going to be the majority allocation, there could be a role for an impact investment, for something that matches your values. And so that as you're growing your hard-earned money, you're making sure that you're putting it towards something that you feel strongly about.
Yeah, so one of the things we do at Kind Wealth is we'll work with our clients who want to, on a consulting basis, move their portfolios and know what's in them and know that they're aligned with their values. And climate is a big issue for a lot of people. And I use the CoPower, the dirty secret in your portfolio
Great.
research, because it's such a compelling piece that most people just don't have the perspective on. They know that certain companies they make investments in can have a negative impact, and as you were mentioning, Sarah, it's the mining companies and the gas and oil and all that, extractive industries, but are unaware that just how much of an impact all sorts of businesses can have on climate. So it's a pretty compelling piece, and it motivates people. But there is this very strong demand and desire out there. So maybe share a little bit, like, what are you hearing from your clients? What concerns do they have? What opportunities? Is it more driven from, and answer this however you like, but I'd be curious, is it more driven from like, hey, there's opportunities there are risks, or it's just this is a values thing for me, and I just care, I don't care what the risks and the opportunities are? Why don't we'll go in reverse order.
Happy to kick it off. So a lot of the clients that I work with at CoPower, I hear three things over and over again. It's, I've been looking for something like you. I've been asking my advisor for something, or I'm fed up with my advisor. I say ESG or I say responsible investing, and they don't even want to look into it for me. So I get a lot of people that are excited to find something that matches their values. And the piece that you mentioned, and this morning at another sustainable finance event, it was mentioned that the TSX 60, which is it's a high growth index. If you just invested in those companies, that would represent a future that is over 3 degrees of climate warming. And so what I hear from investors is, I don't necessarily want to touch a large chunk, but I do want to have control, and I do want to have more options. So we get a strong demand for what else is out there, rather than looking just like a traditional passive fund. What are some other funds? A great example is what Haywan mentions, but a lot of people don't know about it, or don't know about it either from their advisor or just from the people that they get financial advice from. And so something that we're really trying to push is either thought leadership and education and tools for how clients can talk to their advisors.
Mm-hmm. So, Haywan, this is interesting because AGF, a lot of funds are sold through financial advisors and independent financial advisors. And so do you get to connect a lot with those advisors and hear directly from them around their clients, and what do you?
So our clients are now more and more asking about these issues than ever before. We haven't really had heard much in the past from Canadian investors because we are serving global investors. And our clients in Europe have been asking about the carbon issue, climate, risk and opportunities in our investment for probably a longer period than Canadian investors. But definitely we are seeing a lot more requests, and they want to understand how can we have portfolio that are more aligned with the Paris Agreement, or how can we think about maybe divest from fossil fuel or reinvest, and where should we invest? So there can be so many questions, so many conversations around climate change. And exactly as Jennifer said, the problem is many people are not even aware of the options that we have. And now there's so much more products and investment portfolios out there that are a lot more low carbon portfolio than before, and also more on the climate opportunity side. So I think the big part of institutional investors now think about the whole portfolio and how we are going to reduce our carbon exposure and how we can address it. And that is definitely the trend. But again, then what do we need to do? Even for us, my colleagues, my other portfolio managers or analysts, they are all trying to understand what is the best way to calculate climate risk. There are so many variables that are still uncertain. So, we love certain founders. We want to have the certain numbers we can put into our model. And because still on the carbon pricing, or even thinking about physical risk, transition risk, about the operational side, product side, when you think about, within our time frame, again, I think here time frame matters a lot, because short term, mid term, longer term, climate change affects from the short term to over the longer term, and how we are going to model this. And that's why it's still complex issue, and I don't think we haven't this answer yet, perfect answer, but still we have a lot of now more options than ever before.
Mm-hmm. It feels to me like we might be at a little bit of a sweet spot where, you have, because with the growing awareness and the growing interest comes growing supply of options, and you go from a place where, the people aren't aware of the issue and don't know where to turn, and there's not many options to, there's too many options, I don't even know how to decipher them. We might be in that sort of sweet spot where there's growing interest and it's not overwhelming the landscape.
Yes.
And it is good to have more options, but it comes at the cost of paralysis by analysis and feeling overwhelmed. And so we might be in a bit of that sweet spot. It's an interesting segue into your area, Sarah, because, hey, when you're mentioning the point of like, hey, that we want to do this, but how do we actualize it? And so that's where an ESG Global Advisors would come in and work with clients individually to sort of come up with strategies. And so I'd be interested in your perspective on that.
Yeah, so I think the interesting thing is both companies and investors are trying to figure it out at the same time. So what we have is, a growing contingent of Canadian investors who are increasingly sophisticated on this, and our companies need to respond. So we actually service both companies and their investors. So on the investor side, we tend to help asset owners and asset managers who are just getting started on thinking about how to integrate material ESG factors into their investment analysis, their decision-making, their engagement strategies, as well as how they vote their proxies. So we're actually helping them to set up some of these frameworks so they can catch up to some of their global peers. Some of our large Canadian pensions, of course, being leaders as well in this space. So we're seeing some great momentum with our investor clients on thinking about how to do this in a meaningful way. One of the big misconceptions, I would say, is that investors that care about ESG don't invest in traditional high-emitting sectors in the climate change space. So many times I'll be talking with our corporate clients, mining companies, energy companies, and they'll say, the investors who care about ESG don't invest in the mining sector, or they don't invest in the energy sector. And I think that's a huge misconception. So actually the work we've been doing on the corporate side is education. So I heard you say that, Jennifer, and I'm sure, Haywan, that's a big part of your role as well. Education is key. This is an area that's evolving on both sides of the ledger, both the investors and companies getting increasingly sophisticated. Data is always a challenge. But certainly helping companies to understand who are your investors and what do they think about ESG. That's been kind of a big starting point for us. Also helping to educate C-suite and boards about how this links to their core roles and responsibilities as a director of the company, or for example, a CEO or a CFO. And from there, we help them with everything from once they kind of see the light and they realize how important it is to think about climate change issues. We help them do things like materiality assessments, linking it up to their core business metrics, their key performance indicators, building it into their strategy. How does this fit? And the time horizons being a key piece that Haywan mentioned. And fundamentally, how do you tell that story to your investors? So more and more investors care about this. How are you going to disclose that information in a meaningful way? So our clients have a lot of questions. The investors are certainly driving the agenda, and I really don't think that's going to stop.
Yeah, and especially after TCFD final recommendation task force on climate-related financial disclosure, the final recommendation has been monumental for both corporate world and investors world, because now we have framework that we want to be aligned with in terms of our disclosure, not just from corporate, but also from investor side. So investors can ask companies, what are you thinking? What is your governance framework to address climate risk? And how are you going to manage and monitor and measure? So TCFD has been very useful for investors. And now all of us trying to understand, so how we are going to disclose our own activities, our own strategy, our own governance framework aligned with TCFD. So there are so many investors, so many corporates globally now endorse TCFD. And the next level is, so one of the largest collaboration that's going on right now is Climate Action 100 Plus. So we are again engaging closely with companies that are maybe in this high emitting sectors, and those companies now, they are responding to the investors too, and they want to work with us. So what are the then framework that you want us to have? And investors are now, we are having ongoing constant dialogue, and this type of initiative, it's for the next 5 years. So recently they just published the latest sort of the update report, and we are going to continue engaging.
I'm just going to pause for 1 second and say that if the viewers have any questions, we're going to save some time for Q&A. So you can start entering those questions into the chat box, I believe. And we'll circle back in a little bit on those. Hey Juan, can you talk a little bit about the specific climate metrics you look at? And any of the how robust is that data that you're looking at, or the challenges around the data still?
So we do this quarterly exercise on our portfolio looking at environmental footprint. So footprint is a good way to understand how the companies that we are investing in are contributing to climate change. And in our portfolio, we can also thinking about what is the sector allocation or the company selection, how does it attribute to either to our financial return or also looking at the carbon return or the footprint. So we are currently using beyond carbon data, in getting some support from our data provider like TrueCost. So we are looking at greenhouse gases emission data and also water abstraction and waste generation and pollution in the air, land, water, and basically also thinking about the natural resource usage. So all this data that can provide us the good picture of what companies are actually contributing the most. And it's actually quite interesting exercise for us to do, because my portfolio is focusing on the solutions. We talked about this, investing in low carbon technologies, investing in the solutions. Then we are also at the same time can be penalized. So doing this carbon footprinting or environmental footprinting exercise is very important to understand. So what are the sectors out there? There's low carbon sectors and obviously more intensive sectors. So low carbon sector like financial sector, communication services, healthcare, IT. So if you put a lot of investment in these low carbon sectors, then your portfolio now looks great. But it's not necessarily you are investing in climate opportunities. So for us, investing in the opportunities, sometimes you also have to make goods. And when there's a production is involved, then there's also that footprint of production itself, of investing solution technologies. So currently, our portfolio, we are overweight in industrial sector or material sector. And those sectors are also in a highly intensive sector as well. So for us, we are investing in a solution, but at the same time, we have to reduce our own footprint. So this helps us looking at and monitor our footprint and understand what companies are actually contributing this much. And also, this will help us engage with the companies at the same time. So we talk to our industrial companies, like one of the waste management companies, and their footprint looks too high compared to the peers. Then this is a great opportunity for investors like us to engage with companies to understand. And then companies then realize it's really interesting because how company measures their own environmental footprint might differ from how their peers do. So there comes again, we need a standardization, and all this conversation can happen when the investors are more proactively engaging with the companies.
Yeah, I mean, it seems to me that, everyone would like a single,
Yes.
rating number that just tells you definitively this is good and that's bad, and I just need to do this, and now I've cleaned up my portfolio. And what I think you're saying is that it's just a lot more complicated than that, and there's still challenges around consistency of data and what metrics we're using and how they're being calculated. And so it just speaks to me of the need for professionals. Like, you can be well-intentioned as an individual who wants to, or a company or an organization, whatever the case is, and you want to do something positive. And it's easy to just sort of, if you're not an expert in that area, to be misled or to think that you're doing something positive when, so you mentioned an example of where you're investing in this company that's, working on a climate technology or solution, but never mind, wait a minute, what's the impact of that production of that good, and is it counterproductive, all things told. So just that, for me, reinforces this need that I think that people should be looking to professionals for an issue that's as complicated as this. I'll jump over to Sarah. So you have a background in climate accounting. Can you give us examples of some of the companies that are maybe at the forefront on this kind of, on the ESG perspective, and then maybe examples of like consequences for companies that are slow to adopt this?
Sure. So I think Heywan's done a good job of framing up this next question, because fundamentally that was what TCFD is designed to help with in terms of consistency and comparability of disclosure around climate risk. The TCFD recommendations, 4 categories, 11 recommendations, they're really a framework for companies to communicate with their investors, and then investors to communicate to their clients and beneficiaries on climate risk. And so, as Heywan noted, we're seeing more and more uptake of the TCFD recommendations, which is excellent because they're a global framework. And importantly, coming back to our earlier point on CSR versus ESG, these recommendations were developed at the request of the G20 and led by the Financial Stability Board. So certainly some heavy-hitting names, Mark Carney being the person who established this the task force as chair of the FSB. You've also got Michael Bloomberg, who chaired the task force itself. So quite a significant and hard-hitting group, and very much focused on getting some comparability and consistency in the metrics. Interestingly, TCFD is not alone in this game. There are lots of other frameworks out there, and we could probably do a whole separate webinar, and I have done many on all the alphabet soup of these reporting frameworks. But one other one I wanted to mention at this point, and then I'll jump into some examples, is the Sustainability Accounting Standards Board, or SASB. So SASB originally started out of the US. What they've done is come up with sector-specific accounting metrics for use in disclosure of ESG-related risks and opportunities, climate being a really big piece of that. So I referenced some of their research that they think climate change is potentially going to materially impact 93% of US equities. So what SASB has done, and the TCFD working together, is actually come up with an implementation guide that uses both. So TCFD is a framework, SASB provides sector-specific metrics and targets, and the two of them shouldn't be looked at as competing, but actually complementary. So what we see more and more is companies using both of those frameworks to report to their investors on climate-related risks and opportunities. So a couple of Canadian companies that have been at the forefront of TCFD adoption. The first might be surprising to some folks, is Barrick Gold. So a large gold company, global, publicly traded, they have mines all over the world. And they were one of the first Canadian supporters of the TCFD recommendations and are increasingly pointed to as a good practice example. They don't use best practice in TCFD yet because it's too early. But they've been pointed out as a good practice example, especially for their governance disclosures. They explain exactly some of the detail Heywan has offered on how AGF works. They do the same thing in terms of how Barrick's board oversees this, the committees and so on that they use. Another Canadian example is actually RBC. So many people, not on this panel, but many other people kind of don't intuitively see the connection as to why a bank would have to care about climate risk. Well, of course, how they're lending and who they're lending to and the overall impact on their loan books that could be materially impacted by climate risk when we think about things like stranded assets in the transition to a lower carbon economy. So RBC and Barrick Gold are leading examples, and from an energy company standpoint, Suncor. Suncor has been out in front, very honest about the fact that TCFD is a journey. So, really trying to encourage companies to get started. But one of the challenges, I think, in a Canadian context is all of these are household names. These are very large companies with resources to do this type of reporting. And it's really, really challenging for smaller and medium-sized companies, which of course represent almost 99% of Canada's economy. So smaller and medium-sized companies, my advice to them is not to be intimidated by this, actually just to get started. And I'm sure Hewan will echo this, but your investors are looking for some progress. They're not looking for a perfection overnight. And really what they want to know is you've started to think about this in a meaningful way and actually got started on that journey. So being proactive and getting out there and engaging with your investors on this topic is actually a great move for companies that are just getting started.
That's great. It's really interesting. And every time when we do these sorts of talks, people love examples of specific names. So it's really great that you're willing to go out there and talk about individual names. Jennifer, can we talk a little bit about, as an impact investment provider, how do you go about defining and measuring impact specifically when it comes to climate, which is what you're addressing?
So first and foremost, Hewan defined CSR and then ESG. And so if you can think about responsible investing like a scale, the more you go, you can get to impact investment. So an impact investment, first and foremost, has to have a financial return. And then second, it has to have a benefit that's quantifiable. So whether it's emissions that CoPower measures, or it could be number of units of social housing, it has to be something that can be reported and can be audited for investors. So at CoPower, first and foremost, so we have three main impact themes. First and foremost, it is the emissions. So our goal is to help Canada transition to a clean energy future faster. So we will only invest in projects that are either producing clean energy or have an energy efficiency aspect. So we get an independent engineer's report first and foremost, but then our project team gets the energy production from all of our projects each month. And so we can reconcile how much energy is produced and how much savings are actually being recouped. And so we report to our investors each quarter, just along with that, with those reports. And something that's come up, and Sarah touched on this, is the TCFD, there's frameworks that are just getting started for public companies in order to report. But when you have clean energy projects, or if you have a smaller investment firm like us, there aren't regulations around what impact measurement looks like. And so we recently released our impact report. We just did that in August. And it gives a metric not only on emissions, but we also talk about how we align with some of the UN Sustainable Development Goals, as well as what emission metrics are around. And so one of the other impact themes that we are focused on is building a more sustainable business model, a new business model in the energy world. So we finance projects and help developers build out their business where they can scale energy as a service. So rather than go a traditional route, for example, if you're a homeowner, you can get a geothermal unit, and rather than go through the utility, you can have your own renewable source and pay for it just as you would energy. So you're paying monthly increments to pay that system down. So we're working with those smaller companies to help build out that model. And the third is democratizing clean energy investing. So one of the themes when CoPower first started was we wanted to have an investment that was available to retail investors. So it took us a lot of years to go through all the regulatory requirements that, of course, are in place for a good reason. And so within that, we've been able to, for investors in different categories, they have different limits, but have a product that is tailored with a risk and return that is digestible for a retail investor. And so democratizing clean energy investing is, I mean, for us, we have over 700 investors, so it's an impact metric to state, but it's something that we're very proud of. And so, in total, these are metrics that we do report on quarterly, and it's on our website, and it's on each and every client report.
That's great. Yeah, as somebody who's very familiar with the process of the regulatory environment and what it takes to go down that route, is not a small feat, especially for a smaller, when you're not a big bank or a large investment house. So, for extra context, the impact investment space is a fairly new space, and most of the investments there are private market securities, so they don't trade on a public exchange. Makes them a little more difficult to access, and the regulators typically have set up the rules and laws that you have to provide a robust amount of disclosure if you want to make a security available to retail investors. That makes it quite an onerous process, and so you have this situation where retail investors are not able to access most of the impact investments that are available in Canada. So I love that you guys have gone that route. From my Origin Capital hat, offering impact investment opportunities, we're in the same boat where we can only offer to high net worth accredited investors, and we have a strong desire to democratize access. So it is great that you guys have gone that route, because it's a very small number of
And I think it's
organizations
increasingly now there's a lot more focus on 100% impact portfolio investing. So you can, any investment has an impact. So how can you maximize your positive impact? And I think that has been really resonating well with the different investors, whether it's retail or institutional. We want to make positive impact with our money. So how can you do that? And you can do by investing in the companies that are providing solutions. So investing in the positive solution products and services. And also, in a public equity market, you can find those companies still in public investment, and at the same time using this active ownership. So using your investors' right, like proxy voting and engagement. So the active ownership can also make a positive change in corporate behaviors. So I think it goes hand in hand, especially not just in a private side, but also public side, not just in private equity, but also in the corporate debt or in the public equity and other asset classes like real estate and infrastructure. I think those are also other asset classes that, the climate change is actually happening. It's affecting the physical risk of infrastructure. So you have to really think about climate risk and opportunities when you invest in all these asset classes.
100%. I think about it as offense and defense, right? Mm-hmm. So you don't want to be letting in a lot of, investing in traditional businesses that are doing a lot of damage, but you also then want to be doing the positive and finding those, investing in the solutions to the problem. And so you need both if you're going to be a successful. Think about any sport, right? You need to balance both the offense and the defense. They tend to be the most successful teams, right? So that's great. Let's switch gears a little bit and talk about how advisors themselves should be preparing for this, how they deal with, how they handle it with clients. I'll maybe offer to start this because the financial Kind Wealth, that's our mandate. We work with clients. I mean, and I'd love for you to react and just engage in this as a discussion. But one of the challenges, where we often will start with a client is their values rather than a specific issue. So we won't say, hey, let's talk about climate and you need to consider it. We'll start with what's important to you. And we actually have a values exercise we'll go through, and we sort of prompt it with a list of, here's a bunch of values, and I think we've got 40 or 50 of them on the page, and that sparks ideas, and they may have other values that aren't included in that list, but they'll start to mention a bunch of things like community, like leaving a better future, or whatever those things are, justice, or you can imagine a whole bunch of them. And what you'll find is that almost inevitably climate is connected to one of those values, because it's how we treat others, it's the future that we leave, it's the quality of life that we live now, and climate does tend to be a very popular topic for a lot of people because it affects us also intimately. So we start with values, we let people kind of lead into it, and then we start to identify causes, big broad bucket causes that align with those values. So if it's community, it could be affordable housing, it can be environment, it can look education, it can look like a lot of different things. And so we'll sort of lead them down that discussion. And that tends to be very effective because now we're not pushing anything on anybody. We don't have an agenda. We just want you to get more in touch with what you care about. and lead them to that discussion. And once you do, you find that they start to get quite excited about it. And if you can start to lift the hood on their mutual fund or their ETF and tell them what's inside of it, that surprises them. Oftentimes they don't know the first idea of what the top 10 holdings are.
Mhm.
So we find that to be very effective. I'd be curious for your thoughts on how how advisors should be thinking about this. Practically, how do you start to implement this and address it?
Want me to kick it off?
Yeah, please.
So being an advisor, I can certainly tell you our approach with our clients. So tone at the top is incredibly important. And we know that from a cultural change standpoint, from a buy-in standpoint, it's really important that employees working across organizations feel that addressing these issues is something that their board cares about and their C-suite cares about and believes in. And in order to get their attention, we typically will try to understand, obviously a lot of corporates will put on their website kind of their vision, their mission, but perhaps most interestingly is what's their business strategy? Like, where do they want to be? And to your same point, it's kind of a similar exercise. Climate's going to inevitably, across time frames, as you mentioned earlier, Haywan, impact it either positively or negatively across these time horizons. So helping them to understand some of the trends in the broader markets in terms of how investors are allocating their capital allows them to see a little bit more clearly what aspects of their business strategy could be challenged as time goes on, and where they might have more opportunities. So I wanted to give a stat on this because I thought it was quite interesting. The Carbon Disclosure Project, or CDP, a leading voluntary framework for companies and cities to report on their climate-related risks and opportunities. The CDP is aligned to the TCFD recommendations we were discussing earlier. And in 2019, CDP released a report that said companies are actually seeing more upside opportunity than downside risk of climate. 215 of the biggest global companies report almost $1 trillion at risk. Many of them saying it's likely that those risks are going to manifest themselves in the next 5 years. So we're not talking, hundreds of years down the line here. This is kind of immediate in terms of the time horizon of boards and senior management. But interestingly, they also calculated opportunities at 2.1 trillion. So we're actually looking at double the opportunities as the risks. And they said nearly all of those opportunities are highly likely or virtually certain to occur, which tells you something. I think companies, in many cases, risk is an important hook. It's an important conversation starter, but companies get really excited about the opportunities. So that's really where we try to focus, is linking it into what is your current role and responsibilities, not trying to create a revolution, but an evolution of thought.
Yeah, it makes total sense. Talking about mitigating a risk isn't nearly as exciting as capitalizing on an opportunity, especially for a lot of business leaders, I imagine.
That's right.
And I cannot agree more, Sarah, and also your point about what will resonate well with your clients. Mm-hmm. And definitely the opportunity side, always the positive, where we can find the opportunity, the upside. So obviously on the whole point of ESG is how can we protect the downside, and this upside is unlimited. So how can we think about maximizing that upside and while we are preventing the downside? So thinking about, when you look at now what's going on in California, it's just surreal. That is reality. PG&E was the first climate bankruptcy. And if you are just following the companies, with this physical risk that is affecting the company, and that now they just have to cut electricity to millions of households. And this is now happening today. So we cannot just wait. And also climate opportunities. So then you need the companies that are actually providing the emergency, or companies that are helping adapting to the new climate. Those companies will benefit from this. So how you can identify those solution companies, I think that is my job. That is our job, to help our clients to put money into those opportunity areas that are in the water sector, that can be coming from recycling, that can be coming from different energy efficiency and smart buildings, smart infrastructure. The opportunity is just, there's no limit to opportunities.
Yeah. And a lot of our clients know about these issues. They read them in the paper, but when they go to their advisors, it kind of gets lost in the financial dialogue. And so, I mean, outside of this room, we're very passionate about this topic. I continue to this day to hear from clients that say, I asked my advisor about responsible investment options, I got a blank look, and we moved on. And I think a lot of clients feel intimidated because they're passionate about it and they do feel like they do have a good amount of knowledge, but then they get a little bit intimidated when they sit with their advisor. And so I would say to the advisors, I'm sure that your financial institution does have some responsible investment strategy, and would encourage them. And now a lot of funds and even a lot of benchmarks, which are really important for any fund, are disclosing what the carbon intensity is, and what are some of the other emissions. And so that information is available. And so sometimes it takes a little bit of digging, but even asking the fund providers to provide those metrics alongside the benchmark measures to say, okay, well, it might be a good ethical fund, but where do we rate on a carbon intensity? And so I think advisors need to do a little bit more work to be prepared and get ready for those questions, because I mean, this conversation is just going to grow. And still to this day, I have clients that say, I can't bring it up again, or my advisor doesn't know anything about it. Well, these conversations will grow, and just encourage all the clients to say, it's your money, and absolutely you have the right to put it in something that you feel strongly about and something that you value. So having that discussion with your advisor is worthwhile.
And I think there are so many resources out there. So RIA provides marketplace. So if you go to RIA website, and I think you can even pick what's your interest level and where you want to focus on, you can actually get the whole list of offerings so that you can go back to either your financial institutions or your advisors and ask about those.
Yeah, it seems to me, for the same reason we were just talking about opportunities versus mitigating risks and people more interested in opportunities, speaking to advisors on that lens, I was just finished giving a presentation about Kind Wealth and the opportunities for how because we're specifically focused on a younger demographic, and increasingly financial advisors in this country and globally are worried about how they're going to continue their demanded, keep their book of business as this intergenerational transfer of wealth occurs from older baby boomers to their children, and first to their wives who tend to outlive men, and then to the children. And often the children don't stick with the financial advisor. So talking to advisors through the lens of this is an opportunity to engage with people. I think we're seeing Morningstar actually just released some really interesting research that sort of debunks this notion that it's women and millennials who really care about this stuff, and they're finding it's just heightened across the board, which I think anecdotally jibes with what I found anecdotally. But to the extent that there is any truth to the notion that, I think it's certainly, the prevalence is even stronger the younger you go in terms of the demographic. That's a really great way to reach out and connect with the children of your client who has all the money now, but in 5 years from now, maybe passing that on. And so talking about that opportunity to capitalize on it, I think is hopefully something that we can continue in terms of the dialogue in the financial advisory community to get more and more of those advisors, because thinking about it, talking about it, because it does feel very much right now that clients are dragging their advisors into it. And it's only happening if they've got enough money and enough wealth, and there's enough of them that the advisors go, oh, right, I've got to pay attention to this.
Yeah.
So instead of reacting, let's get them excited about the opportunity to capitalize. And so I'm hopeful that will come up. One quick question. I've noticed, I saw some data, and I don't even know where I saw this anymore. And again, anecdotally, it feels right to me. I'd be curious if A, you've seen any research, or B, your observations on this, that the idea of aligning your investments and your values has the kind of the benefits of feeling good, that the data supports that at the very least it doesn't underperform, and we've, I think, got a fair bit of data that says it outperforms, but also that it affects investor behavior, and that when you buy something for some reason, buy an investment for a reason other than maximizing your financial return, that you're more likely to stick with it and sort of get out of that bad habit of greed and fear driving your decision making. So buying high and selling low, which is the exact opposite of what you should do. And so that it narrows that gap between the reported returns you see on investments and the actual return that the investor experiences, because they're not buying and selling at bad times. So I'm curious if A, you've seen any of this data, B, what your sort of experience with that with clients is. Do they tend to hold on longer and make better decisions with their investments because they are bought in for some other reason than just, I'm going to maximize my return?
Definitely, I can talk about that anecdotally because I went through financial crisis back in 2008 in the UK. And again, it was stark contrast between sustainable investing assets versus back then, socially responsible investment asset. This responsible investment or sustainable investment asset was so much stickier, even going through financial crisis. And many of the investors, they are not investing in this type of funds just for the short term, but they are putting this money into generational wealth. So for their children, so they tend to think about the longer term. So that almost our clientele, their interest, their time frame is almost in line with investment managers, that we are thinking about the longer term period. And I guess same thing with a pension. And when your pension, it's not just about the next quarter or next 6 months, but it's over decades. So you are thinking more about the longer term. That's where always I found interesting the contrast between the sustainable asset or our clients.
Yeah, I'd echo that point, and I was going to say something similar about the short-term performance, and especially if you're an active manager, and so it's to a benchmark, and you're looking at relative performance. You can, over a year or even 3 years, but with most of our investors at CoPower who are putting their green bonds into their RRSP or even a TFSA, their timeframes are 10 years plus. And so they're happy to roll over, they're happy to stay because they've allocated X amount, 10, 20% towards impact investments, and they're getting the return that they've expected. And to your point, that the financial metric is there, so that's the check mark, as opposed to the ESG is the check mark or the impact is the check mark. They're getting the financial return and the impact, and so that stays. And it's not something that they're looking to roll over, and they're not checking it against another mutual fund or another stock. That relative performance is not an issue for those investments.
And over the years, what I found is, so in the past, there were always questions about performance. Are we going to lose money? And that fear of our investors, if we are putting money in sustainable investment, then are we going to lose money? But now we are not getting those questions anymore. And I think there's an understanding, and because also there are so much more products and offering out there, and with the competitive returns. And I'm definitely not thinking about I'm going to sacrifice my return at all. I want to provide higher return than the market, than peers, and that is my goal. And at the same time, I want to make the positive change and the impact while we make the positive return.
Yeah, I can't help but note, I'm not sure if everybody's age on this panel, but growing up in the 80s with, Wall Street and Michael Douglas were as good, where, in this sort of shareholder, maximizing shareholder value is your sole objective. It's mind-blowing to me how quickly this is now shifting, and people are realizing how irresponsible that is to just not have any regard for the impact that your investment or your business has on the community, on the planet. And that's really rapid. Like feels like the past 10 years, but even the past 5 years it's just growing that awareness. So it makes me very hopeful.
Yeah, even the past 5 months, because in August, we saw Business Roundtable of
that's right.
top 180 CEOs. Now they are saying we are rejecting Friedman Doctrine. And our corporate responsibility is on a stakeholder, and it's about the social contribution to society.
Yeah. I mean, for me, it was when, that moment came when Larry Fink at BlackRock came out with a big sort of announcement is around the time of the shootings in the US and the gun violence, and saying we're going to remove guns from our portfolios, and then went to make on the broader statements like that you have to put purpose and your, some sort of greater community or societal impact at the forefront of your business, was such a sort of shockwaves, I think, to the industry. Because I don't think that, I don't know Larry Fink personally, but I don't think that he's doing it because it's necessarily, that he's trying to change the world, but that it's so clear from a business perspective, you just absolutely, it's becoming an imperative. And that comes from individuals, ordinary individuals, making decisions about how they spend their money and how they invest their money. And so for anybody who's listening and people in this space, your individual decisions, voting with your dollars, both how you spend them and invest them, is important to catalyzing this change. So I guess with that, we'll wrap up, but I really appreciate you taking the time. It's been a lot of fun. I've learned a lot. As I say, I'm familiar at the high level of these issues, but getting into some of these details has been really insightful and valuable. So thank you very much.
Thank
Thank
you.
you.
Thank you.